Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome back to another episode of Alternative Investments Chat. Today's episode is all about innovation in investing and, more importantly, where the capital is actually moving here in 2026. And if you think that innovation in investing is just about AI chatbots helping you write emails, because that's what the old folks do, or about those crypto headlines, well, you're most likely already behind, my friends.
Yeah, exactly. In 2026, capital is moving into some of the most unexpected places, like autonomous systems, high-speed fiber optics, energy grids powering data centers, tokenized treasuries, near-shored manufacturing, and even space-based infrastructure.
Yeah, so let's unpack what Q2 is actually showing us where institutional money is quietly flowing, which sectors are attracting the most capital, while alternative assets are having what I consider a major movement right now, and how investors can think about positioning themselves in a world where innovation in investing isn't just about chasing that next hot stock, NVIDIA. No, all the other ones as well. But before we actually dive in, please make sure that you have subscribed, turned on those notifications, and leave us a comment telling us, maybe which innovation that you're most curious about this year. Again, we love hearing from you and what you're actually watching.
Yeah, exactly. Okay, so let's zoom out for a second and look at the big picture forecast for Q2 of 2026. I'm talking about the macro forces here that are shaping where investors are positioning their capital right now. Q2 2026 is shaping up to be a really interesting crossroads between economic reality, technological acceleration, and shifting investor psychology. The big forces driving the investment landscape this quarter are artificial intelligence expansion, infrastructure demand, and structural innovation in private markets. Reports from firms like BlackRock, Morgan Stanley, and McKinsey show that private markets are becoming more integrated into standard portfolios. What used to be alternative is now becoming mainstream.
Exactly. And on top of that, we're also seeing liquidity structures changing. Instead of traditionally closed-end funds locking capital for years, we're seeing growth in evergreen funds, interval funds, and tender offer structures. This is expanding access while managing that liquidity with more flexibility. And at the same time, secondary markets are growing, allowing investors to rebalance private equity exposure instead of waiting for long cycle exits or long exit cycles. The other way around. We gotcha.
Okay, so let's dive into one of the most talked about innovation themes that is heading into 2026. This is agentic AI and infrastructure. Artificial intelligence seems to be all anyone's ever talking about for the past few years. And this is like, chatbots, image generators that for some reason everybody is using as their profile pics.
Dude, on the Christmas ones, the ones where you had to put the
caricature ones.
Yeah,
it's not my vibe.
And then I like the ones who respond to the likes that they get on it. Like, sir, that is not really you.
Yeah, I know. Not really you. And even automated customer service, which I think we all have a bone to pick with that. But you could ask AI a question and AI spins out the answer. Pretty cool. But agentic AI is the next step, the evolution of that.
I know. So instead of just AI responding to a prompt, agentic systems can actually take actions on their own, which kind of is creepy, but think of it as like a digital employee, if you will. These systems are designed to plan, execute tasks, adapt and make decisions within those boundaries, of course. They don't just wake up one morning and be like, I'm going to do this for you. No, you have to put in some restraints on it, okay? But businesses are no longer using AI for convenience anymore. They're actually using it for productivity and cost reduction. And when companies see tech that can lower cost and increase that output, capital tends to start flowing and quite quickly, if you ask me.
Yeah, exactly. And here is the interesting part for investors. The agentic AI boom isn't just about software companies. It's actually creating massive demand for something a little bit less flashy, infrastructure.
Mhm.
We know that AI requires a ridiculous amount of computing power, and I do mean ridiculous.
Yeah.
Training and running advanced AI systems requires huge data centers, specialized AI chips, massive electricity consumption, and high-speed network infrastructure. So while headlines are focusing on AI applications, institutional investors are also looking at quietly pouring money into AI supply chain because one can't exist without the other. AI can't exist without it. And first up on that chain is the data centers.
That's right. So every AI query, model training run, and automated task has to be processed somewhere, right? And that somewhere is usually an expansive warehouse facility somewhere packed full of servers, GPUs, which is graphic processing units, cooling systems, and fiber connections. And if you just take a drive around here in the valley, you'll probably see a data center on every corner like a Starbucks, or at least so it feels like here in Arizona. But tech companies are actually racing to build new facilities, expand existing ones, and secure land and power access. So for the investors, this means they are actually pouring their money into data center real estate, specialized infrastructure funds, energy contracts tied to computing demands. And these data centers are becoming the industrial factories of the digital economy.
Yeah.
It's kind of wild.
Crazy how the world evolves
Right.
just in my lifetime. But up next, we have another innovation theme that sounds boring until you realize that there are billions of institutional dollars quietly flowing through it. Investors are calling this theme pipes and power. Now, while this might not scream cutting edge innovation, we need to remember that sometimes the most important innovations are the ones that make everything else possible. So let's talk about pipes. Energy has to move from where it's produced to where it's used. So this means pipelines, transmission lines, and transport infrastructure. A lot of current infrastructure is aging or is just really inefficient. Whether it's natural gas pipelines, hydrogen transport systems, carbon capture networks, electricity transmission grids, there is an enormous amount of capital that is needed to actually be able to expand these systems and modernize them as well.
Yeah, because what was good then isn't good now, right? So, which is exactly why investors love infrastructure. It's a predictable cash flow. Now, let's talk about the power side of that equation. When you think electricity generation, I'm sure you're not thinking, woohoo, how about there's a hot investment theme there?
I just think about the electric slide.
Electric slide. There we go. That's how our brain goes. Anywhere singing or dancing.
Yeah, exactly.
Right?
Boogie, oogie, oogie.
All right. So between AI, the electrification of practically everything, we just did an episode on solar panels, but everything's becoming electric.
It's electric. Sorry.
And now in the slide, and those industry demands, electricity consumption forecasts are climbing once again. So where we're seeing capital actually flow into were renewable energy projects, natural gas generation, grid scale battery storage, nuclear innovation, and utility modernization. Man, I got lots of long words in there. Even those traditional energy companies are repositioning themselves as energy infrastructure providers, not just commodity providers. So they're trying to, everyone wants a little piece of that game because the world doesn't just need energy, it needs reliable, scalable energy systems.
Exactly. Okay, so let's move into another theme here that institutional investors are paying very close attention to this year. And the theme is defense and autonomy. Now, historically, defense is pretty straightforward. You think about large aerospace companies, long government contracts, and technologies that have evolved slowly over decades. But the defense landscape is changing rapidly. The reason is extremely simple, though. Modern warfare is becoming increasingly automated, data-driven, and software-enabled. Autonomy in this context refers to systems that can operate with minimal to no human contact or control. We are moving towards a defense environment where machines can sense, analyze, predict, respond faster than humans could ever manage. And that's fundamentally changing how governments are thinking about defense spending.
Yeah. And one of the clearest examples of this shift is the explosion in drone technology. So these explosion.
Bunch.
Yeah. They are exploding. So these unmanned aerial vehicles used to be niche tools. when we were talking about this episode before coming in here, we talked about how I once heard what I thought was bees, and it was actually a drone outside because I'd never seen one, heard one, or anything like that.
And they were mostly used for spying.
Yeah. Or nerds who live next door.
Yeah.
AKA spying. Yep, exactly. So, however, they are actually becoming central to modern military strategy, which is also spying. Drones are cheaper, scalable, and capable of operating in environments that would most likely be dangerous for human pilots. So I like that part about it. And just with a little bit of research I was doing during this episode, they're evolving quickly. There was you just put in drones and get lost. Today's systems include reconnaissance drones, swarm drones that coordinate in groups. Those freak me out.
It's like the light shows.
Autonomous,
Scarier.
Yeah. Oh, I forgot about that. So I guess that is, okay, I like the light shows, but only then.
Yeah.
Autonomous target system, targeting systems and long duration surveillance platforms. So again, foreign investors, the only people we care about, this means capital flowing into companies working on robotics, sensors, navigation systems, and AI-enabled targeting software.
Yeah, and it feels a little bit like an episode of Black Mirror.
The new season. If you haven't watched the new season of Black Mirror, it's weird. There's some weird stuff in there.
Weird stuff. But our next theme is Black Mirror. I'm just kidding.
Yeah.
Our next theme is what analysts are calling geopatriation. Now, this might sound like a complicated term, but the concept is actually pretty simple. For the last 30 years, the global economy was built on maximum efficiency. Companies spread production all over the world to lower costs, right? We know that. Anything that comes to you typically has parts from a lot of different places. And they all cross borders and then essentially all come together to form your iPad. And now you have it here. Your iPad is a world traveler. Yeah, right. Has a great passport. But it was the golden era of hyper globalization. However, in the last few years, we have been shown something important. Efficient supply chains are great. They're ideal, in fact, but they can break. And let's think back to the past decade, even though we don't really want to. Pandemic shut down factories, shipping bottlenecks, delayed goods for months, geopolitical tensions disrupted trade routes, critical materials suddenly became scarce, something that you were able to get all the time very easily. Toilet paper. You go to Costco and all of a sudden there is none. So companies and the government started thinking that relying on one factory that also happens to be located on the completely other side of the world, very difficult to get to and communicate with in times of struggle, isn't maybe the best idea. Maybe we need some other options. And that is the simple realization that is driving the geopatriation trend. Basically, this means bringing critical production closer to home, or at least closer to potentially your allies, people that maybe you have less potential to fight with.
Fight with.
You have probably heard the terms like nearshoring, reshoring, friendshoring. They all have different labels, but they basically mean the same thing or are talking about the same idea. Make supply chains more secure, more resilient, and easier to get to.
And for an investor perspective, again, this geopatriation has a few things institutions love. First, it's multi-year structural trends. So rebuilding supply chains isn't something that just happens overnight. It can take years to build factories, infrastructure, and logistics networks. Second, it actually touches multi-sectors. So there's industrial, infrastructure, technology, energy, materials. So this makes it a broad investment theme rather than just a single trade. And then lastly, we have, it has strong governmental backing. So when policy and capital markets move in the same direction, when they're on the same page, trends can gain serious momentum.
Totally. Oftentimes government can be the reason why things move slowly. So if government's on your side, you got rocket fuel, basically.
Exactly.
So let's close out our innovation themes here with one that used to live purely in the realm of science fiction, but is now becoming a very real investment category. And that theme is space and satellite infrastructure. When people hear space investing, they often, at least me, conjure up images of rockets blasting off into space, or astronauts floating around, or Did we fake the moon landing or taking vacations to other planets? I don't know.
Yeah.
Maybe we got some tin hats in the audience today.
Yeah.
But while that's all fun to think about, the real investment story happening right now is a lot more practical. We are talking about infrastructure that is orbiting above our heads and powers our modern life every day.
Yeah.
And we're talking about satellites. Things that you may not know or think about depend on satellites like GPS, weather forecasting, global communications, virtual fitness classes, home security systems, language learning apps, so many things. And I'm sure this comes as no surprise that the demand for satellite services is growing rapidly in 2026 for a very simple reason, though. The world is becoming more and more connected.
Yeah.
More data-driven and more reliant on real-time information. Satellites are one of the fastest ways to deliver that connectivity and data anywhere on the planet, which is why we're seeing the rise of what analysts are calling the space infrastructure economy.
Well, if you even, the real time is like triggering because like that's every single time you watch any news or anything, like real time happening now. You're like, but again, we don't really think about how you get that information.
Right. But the news is kind of like this.
Yeah, exactly. So from an investment perspective, space infrastructure has a few characteristics that attract investors. So first, we've got that long-term demand. You mentioned connectivity, data, and surveillance needs are only increasing as the global economy digitalizes. And then second, we've got falling launch costs, which is, so we're reusable rockets and new launch technologies have dramatically reduced the cost of putting satellites into orbit. It used to be a very, very expensive. It's still just very expensive,
Yeah, still expensive, but better.
But better, yeah. And third, the sector is expanding beyond pure aerospace into areas like data analytics, telecommunications, and cloud services. So what used to be, again, a little small industry is becoming a multi-sector technology ecosystem. See lots of those up there.
Yeah. Okay. But let's hold our horses here, people. Before you run out trying to diversify your portfolio around AI data centers and drone fleets and satellites and everything else that we talked about here, we need to talk about the risks.
Of course.
We get it. We made innovation investing sound so amazing and cool. We know that there's definitely going to be a spike in searches because of our great podcast episode. But you have to be aware because there is definitely growth in this sector, but it's also somewhere where capital can get burned the fastest. So we need to politely remind you that we are not experts here.
Nope.
And you need to do your own due diligence. Let's take a little stroll through our major risks that come with these innovation themes and the questions that you, the smart investor, which we all know our listeners are, should be asking. So the first risk, confusing a great theme with a great investment. All the themes we talked about here today are real life trends and very exciting ones at that. But there is a catch. Not every company that's participating in this trend will be successful, right? Let's just look at some past innovations. The dot-com boom brought us Amazon. Thank you, Lord.
Yes.
For Amazon. Love that. Very convenient. But we also saw hundreds of companies disappear. And in fact, some companies that were huge giants, like let's think about Walmart, has really struggled trying to keep up with Amazon. So that's, one example. Solar boom. We have a huge industry that was created, but a lot of early solar companies went bankrupt. They didn't make it. And also the electric vehicle wave. Yeah, we have the Tesla and we have the Cybertruck that looks like it's made of Minecraft block or something.
Ugliest thing I've ever seen on the planet.
Yeah, I mean, to each their own, but it looks futuristic, that's for sure.
That's what we were going for. Then they mission accomplished.
They nailed it. Yeah. But dozens of other companies are still struggling with the electric vehicle wave, struggling to keep up. And even big companies like Ford and like big car companies aren't able to compete as well. So one of the first due diligence questions should always be, is this company actually positioned to benefit from this theme, or are they just marketing themselves as part of it? You have to try to see the longevity.
Yeah. It's like Inception kind of. Like, are you really it, or are you just trying to pretend that you're it? Anyway, another characteristic that these themes share is that they are extremely capital intensive.
Totally.
So these projects require billions of dollars and often take years to generate returns. So questions that investors should ask themselves before investing is, does this company have enough capital to actually finish the project? It's a great idea, but can we finish her? What happens if financial conditions actually tighten? And then lastly, is this business model viable without constant fundraising? Those are things. You don't want your money to just disappear, right? Innovation is exciting, but cash flow still matters. Another major factor across these themes is government involvement, like we just mentioned earlier. A project that looks profitable could face delays if regulations change, environmental reviews slow construction, government budgets shift. We've seen budgets come and go, and geopolitical relationships evolve. So again, investors should ask, how dependent is the government in this investment to make sure that it can keep going?
Yeah, exactly. And waiting is not really an option when it comes to innovation. Innovation doesn't wait for you.
Nope.
You shouldn't wait for innovation. In fact, that's our next risk here. Innovation sectors move really quickly, sometimes quicker than investors expect. Sometimes technology that looks cutting edge today can be leapfrogged within a couple of years. Let's just think about AI in general. It has compounded onto itself at a rate that's quicker than anything I've experienced.
I just think about even the evolution of the iPhone. How many iterations have we had of this? And and there's another one, and I feel like I'm always behind. And
Totally.
or you're much younger than I am, but we used to have the old Macs in our computer labs, and now one's in a museum.
The big fat one.
Yeah, one's now in a museum, which makes me.
We found a box of that up in our attic at our new house. It's like the box that from whenever that computer came out, but it's the original box.
That's
no Mac inside, unfortunately. That would be cool.
Anyway.
But things change like crazy. And thinking about how hardware evolves or how rapidly software capabilities improve, you have to be aware of that. And you have to think about the following due diligence question, and it may be crucial to you. Is this company building a desirable platform or just a temporary technological edge? Do they have the momentum to continue to be cutting edge? Because in innovation investing, today's breakthrough could probably be tomorrow's outdated hardware. It always happens. So you have to try to find a company or a product that has a longevity, can stand through the time. And finally, there is a simple risk of all. Execution. Building infrastructure is really hard, even if you have a really great idea. Sometimes it doesn't work out. Launching satellites is really hard. Seen a lot of those not go well. All of these things that we mentioned are hard. Even with great technology, strong demand, these companies still have to execute their project, even if they have everything laid out on paper perfect. Sometimes it doesn't go that way. And history shows that many ambitious projects fail because execution proves to be way harder than actually expected.
And again, once more, to reiterate, risks are real. And as an investor, you should always do your due diligence. Again, we want to continuously preach that to you. So, all right. So we've spent this episode talking about innovation themes, shaping where capital is moving in 2026. But now I think we should just take it back just a second to a very, very practical question investors always ask as a new quarter approaches. What the heck's going to happen in Q3? Well, we talk about what's going to happen. So let's just quickly go over a few things that investors should keep on their radar.
Great idea. So first up, we have earnings reality. In the first half of the year, we're seeing themes and expectations, but by quarter three, we want the proof. Are these companies actually benefiting from these themes? Another huge question is whether the capital spending cycle that is tied to technology and infrastructure is going to continue at the same pace. These investment cycles are known for coming in waves. Investors should really pay attention to whether these corporations continue to fund these projects or if it all of a sudden is pushed to the back burner. A slowdown might not kill the entire project off, but we could see the stocks connected to it cool down and your returns cool down.
The only time I really like to see that word cool down is when I'm riding my Peloton and it's the cool down spot. So
thank God.
I'm like, whoo, I made it. So next up, we have rates. We have rates and liquidity. These themes may be dominating the headlines, but at the end of the day, capital markets still evolve around one core value, right? Variable, the cost of money. How much money do I need? How much money do I have to give you back to have money?
Yeah.
So in Q3, that companies may need to actually reassess how expensive it is to fund these long-term projects. And in innovation investing, liquidity matters just as much as that technology does. Lastly, we have the wild card of geopolitics.
My favorite.
Again, always there. Many of these themes we discussed here today are directly tied to government policies. So investors should always remember that innovation doesn't happen in a vacuum, okay? It happens inside a political and regulatory environment that can shift at any second.
Yes, totally. And that brings us to the end of this episode. But before we wrap things up, let's zoom out and look at the full picture here. We walked through some of the biggest innovation themes that are shaping investor capital flowing in 2026. Now, if you actually look at the big picture as a whole, you can see a pattern that's starting to emerge. Innovation isn't just about apps, software platforms, or the next viral technology startup. It's about building physical and digital systems that power the global economy.
Yeah, but as exciting as these themes are, which we loved researching, we also talked about the other side of that equation, and that's the risks and the due diligence. So history has shown us that innovation cycles produce incredible winners, but there's also plenty of casualties along the way. So this is why investors need to stay disciplined and look at all the things, all of them, and not just focus on the theme.
Yeah, totally. The global economy is entering a period where technology, infrastructure, and geopolitics are converging in ways that we haven't seen in decades, especially as new technologies are coming out. It's hard to really foresee how all of those things will converge. For our investors, this convergence creates a landscape filled with lots of really cool opportunities and meaningful complexity, and also, some pitfalls. So invest in it thoughtfully.
Yep. And again, thanks again for tuning into this episode. We hope you'll join us next time. And until then, we'll see you.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.